The European Union has made a grave error, one that may prove far more costly than its architects anticipated. What EU leaders believed to be a decisive act of economic statecraft has instead set off a chain reaction that is now destabilizing Europe's own financial position. In a move framed as both punishment and principle, Brussels authorized the seizure of $15 billion in Russian assets that had been frozen since the invasion of Ukraine. The funds were redirected to Kiev as aid, compensation, and a symbolic demonstration of Western resolve. The intention was clear: penalize Moscow, reinforce European unity, and underline that military aggression carries consequences. The outcome has been very different. Rather than deterring Russia, the decision provoked a calculated and highly effective response, one that has left European governments privately alarmed. Moscow did not escalate militarily. There were no cyber offensives, no sudden shutdown of energy supplies. Instead, Russia chose a far more strategic path. It moved to reshape the rules of international finance in a way that directly undermines Europe's economic interests and potentially its long-term credibility. This story is not simply about Ukraine or Russia. It goes to the heart of the post-war financial order and raises serious questions about Europe's role in weakening the very system it helped build. To understand how we arrived here, it's important to look at the facts. Following Russia's invasion of Ukraine in February 2022, Western governments froze roughly $300 billion in Russian central bank reserves held across Europe and the United States. The scale of that action was unprecedented. Never before had the sovereign reserves of a major power been immobilized so completely. From the outset, the legal footing was uncertain. These were not the assets of sanctioned individuals or criminal networks. They belonged to a national central bank. For 2 years, the funds remained frozen. Russia repeatedly demanded their release. The West refused. But freezing assets is one thing. Confiscating and reallocating them is another entirely. And that required a legal basis that was, at best, improvised. European legal experts warned that outright seizure would breach international law, erode the principle of sovereign asset protection, and establish a dangerous precedent. Those concerns were brushed aside. In November 2025, the European Council voted to confiscate $15 billion from the frozen reserves and channel the money into a Ukraine reconstruction fund. The legal rationale was novel. The assets were reclassified as reparations for Russian aggression. The political response was celebratory. EU leaders hailed the decision as bold and necessary. Media coverage framed it as a moral victory for Ukraine. Senior figures jostled for recognition. Russia's initial reaction appeared restrained. There were formal protests, warnings of retaliation, and familiar diplomatic language. Many Western analysts dismissed it as posturing. After all, Russia was already heavily sanctioned and largely excluded from Western markets. That assumption proved to be a serious misjudgment. Russia's response unfolded in 3 distinct stages, each more damaging than the last. The first was swift and direct. Within 48 hours, Moscow announced the nationalization of all European corporate assets on Russian soil. BP's stake in Rosneft, valued at $14 billion, was seized. Shell lost operations worth $3 billion. Total Energies saw projects worth $4 billion confiscated. Societe Generale's banking business was taken over. German automotive plants belonging to Volkswagen, BMW, and Mercedes were nationalized alongside pharmaceutical facilities, food producers, retail chains, infrastructure projects, and intellectual property. In effect, every significant European asset in Russia became state property overnight. The total value exceeded $120 billion, several times more than the sum seized by the EU. The impact across Europe's corporate sector was immediate. Boardrooms were thrown into disarray. Shareholders demanded explanations. Stock prices fell sharply. Insurers were confronted with enormous claims, and this was only the beginning. The second phase targeted energy, but not in the way many had expected. Rather than restricting supply, Russia announced that all remaining energy exports to Europe would be priced exclusively in rubles or yuan. Euros would no longer be accepted. This was a strategic move. Cutting supply would have reduced Russian revenue. Instead, Moscow forced a currency decision. European buyers now had to obtain rubles or yuan before purchasing gas or oil. That meant using Russian or Chinese financial channels, absorbing additional costs, bearing exchange rate risk, and sacrificing transparency. The deeper significance, however, was symbolic. By rejecting the euro outright, Russia sent a clear message. Europe's currency was no longer considered acceptable for critical trade. A major commodity exporter was effectively sidelining the euro, a currency long assumed to be globally usable. The consequences rippled quickly. Energy importers were forced to build ruble reserves, selling euros in the process. Selling pressure on the euro intensified. The ruble strengthened, the opposite of what sanctions had been designed to achieve. Meanwhile, China benefited substantially. Purchases settled in yuan required buyers to hold yuan reserves, accelerating the currency's international use at the euro's expense. The European Central Bank was left watching as euros were exchanged for rubles and yuan, weakening the currency and importing inflation through depreciation. Then came the third and most consequential move. Russia announced the creation of the BRICS Plus Reserve Fund, a $150 billion facility backed by Russia, China, India, Saudi Arabia, the UAE, and other states increasingly uneasy with Western financial leverage. The stated aim was to provide liquidity and stability for countries vulnerable to sanctions or asset freezes, effectively an alternative to the IMF for governments seeking insulation from Western control. But the true innovation lay in the structure. Sovereign assets deposited with the fund would be held across multiple non-Western jurisdictions under distributed custody arrangements. No single authority could freeze them. No Western court could seize them. The assets were deliberately designed to be beyond reach. China contributed $50 billion. Russia pledged $30 billion. Saudi Arabia and the UAE added $25 billion each, with the remainder coming from India, Iran, and others. This was not simply a financial instrument. It was new infrastructure, designed explicitly to bypass Western dominance. For many governments, the implications were unavoidable. If Russian reserves could be confiscated in Europe, how secure were their own assets in London, Frankfurt, or New York? Increasingly, the answer was uncomfortable. Capital began to move. Saudi Arabia reduced its exposure to European assets. The UAE shifted parts of its sovereign wealth portfolio towards Asia. China accelerated its move away from euro holdings. Even non-aligned states such as Indonesia, Malaysia, and Mexico began reassessing their reserve strategies. The sums involved were immense. Central banks and sovereign funds hold trillions in European assets. A modest reallocation translated into hundreds of billions in selling pressure. European bond markets responded accordingly. Yields rose. Borrowing costs increased at exactly the moment governments needed to fund Ukraine support and energy transition programs. The European Central Bank faced a dilemma with no easy answer. Intervene aggressively and risk reigniting inflation, or allow yields to climb and expose governments to mounting debt pressures. In the end, it chose a compromise. Limited intervention that prevented outright crisis but failed to restore confidence. And that lack of confidence now hangs over Europe's financial future. The consequences were felt quickly and unevenly across Europe's major economies. Germany bore the brunt of the fallout. No European country had deeper commercial exposure to Russia. German manufacturers had spent decades building a presence there, particularly in the automotive sector. That investment was wiped out almost overnight. An estimated $30 billion in assets vanished. BMW's plant in Kaliningrad was lost. Volkswagen's operations were seized. Mercedes' facilities were nationalized. These were not marginal losses or write-offs at the edge of balance sheets. They represented long-term strategy, future revenue, market access, and hard-won competitive advantage. For German industry, years of patient expansion were erased in a matter of days. The political repercussions in Berlin were immediate. Opposition parties accused the government of backing asset seizures without securing protections for German firms. Business groups demanded compensation. Ministers had little to offer in response. Germany had supported the EU's decision in the name of solidarity, and German companies were now paying the price. France faced its own reckoning. Total Energy's exposure in Russia triggered shareholder litigation. The French state's stakes in companies with Russian operations fell sharply in value. Société Générale's Russian banking arm, built up over 15 years, was taken over, forcing a $3 billion write-down. Elsewhere, the pattern repeated. Italian energy firms with Russian partnerships were nationalized. Spanish food processors lost production facilities. Dutch agricultural companies saw operations confiscated. Across the continent, major European firms absorbed heavy losses as a direct result of Moscow's response. In short, no major European economy escaped unscathed. Energy compounded the problem. Several EU member states, despite years of diversification efforts, remained dependent on Russian supplies. Those countries now had to operate within a ruble-based payment system. Hungary moved first. Maintaining pragmatic relations with Moscow, Budapest established ruble accounts and continued importing energy. The economic logic was clear, but the political consequences were significant. Other EU states, which had rejected Russian energy on principle, watched Hungary secure cheaper supplies by accepting ruble payments. Austria, Slovakia, and parts of Eastern Europe faced the same dilemma: accept ruble settlement and stabilize energy costs, or refuse and pay more through alternative suppliers. This is where European unity began to fracture. States with access to Atlantic LNG terminals could afford a tougher stance. Landlocked countries dependent on pipeline gas had far less room for maneuver. Policy coherence gave way to national necessity. From Moscow's perspective, the outcome was predictable and advantageous. A divided Europe is a weaker Europe. Yet the most serious damage went beyond immediate economics. The precedent set by the asset seizure sent shockwaves through the global financial system. Any country holding reserves in European institutions was forced to ask an uncomfortable question. If Russian assets can be confiscated, whose might be next? Chinese reserves in a future Taiwan crisis. Saudi assets amid another energy dispute. Any nation caught on the wrong side of a geopolitical confrontation. There was no reassuring answer. Nothing, in practical terms, would prevent it. That realization triggered what analysts now describe as a confidence crisis in sovereign asset safety. Central banks are conservative by design. Their responsibility is to preserve value and minimize risk. Assets exposed to political seizure are, by definition, risky and therefore unattractive. The rational response was diversification. This process is gradual. Central banks do not move capital abruptly, but the direction of travel became unmistakable. Reduce exposure to European financial centers. Increase holdings in jurisdictions perceived as politically neutral or strategically restrained. Ironically, that shift favored Switzerland and Singapore, and increasingly China. For many non-Western states, Chinese custody arrangements began to look safer than European ones. The broader implication is stark. By weaponizing finance so aggressively, the European Union has weakened the global appeal of its own assets. And that loss of confidence may prove far harder to reverse than policymakers in Brussels or Westminster initially understood. European bond markets responded accordingly. Yields rose. Borrowing costs increased at exactly the moment governments needed to fund Ukraine's support and energy transition programs. The European Central Bank faced a dilemma with no easy answer. Intervene aggressively and risk reigniting inflation, or allow yields to climb and expose governments to mounting debt pressures. In the end, it chose a compromise. Limited intervention that prevented outright crisis, but failed to restore confidence. And that lack of confidence now hangs over Europe's financial future. To understand the scale of the error, we need to look beyond the immediate fallout and examine the long-term strategic damage. For decades, Europe cultivated a reputation as a safe and neutral destination for global capital. Swiss banking secrecy, Luxembourg's fund structures, and London's financial services industry all played a central role. European financial centers positioned themselves as stable, predictable alternatives to New York, places where money could be parked with confidence. The euro itself was promoted as a credible rival to the dollar, a reserve currency underpinned by legal certainty and institutional restraint. That positioning relied on one essential factor: trust. Trust that property rights would be upheld. Trust that political disputes would not spill over into financial confiscation. trust that the rule of law would take precedence over short-term geopolitical advantage. The seizure of Russian assets shattered that assumption. European financial centers are now viewed, particularly outside the West, as politically contingent rather than legally neutral. The language of the rule of law has been quietly displaced by talk of a rules-based order, increasingly understood to mean rules applied selectively, adjusted when circumstances demand. That shift has serious consequences for the euro's standing as a reserve currency. Central banks hold reserve assets for two reasons: safety and liquidity. If assets can be seized on political grounds, they are neither reliably safe nor fully liquid. That reality has not gone unnoticed. The euro's share of global reserves had already been declining. The Russian asset seizure sharply accelerated that trend. Confidence has been eroded, and once lost, confidence is exceptionally difficult to recover. One country, however, emerged as the clear beneficiary. China capitalized on Europe's misstep. Capital leaving European assets did not disappear, it was redirected. A significant share flowed into Chinese markets or yuan-denominated instruments. Beijing's long-running campaign to reduce reliance on the dollar, and now the euro, received a decisive boost. The launch of the BRICS Plus Reserve Fund underscored that shift. Demand was immediate. The fund reached its $150 billion target in a matter of weeks. China presented itself as a guardian of sovereign asset protection, a counterweight to what many states now perceive as Western financial coercion. This was not merely a messaging exercise. China offered practical alternatives: yuan-based payment systems, custody arrangements beyond Western jurisdiction, and financial infrastructure designed to be resistant to sanctions. Europe's decision effectively fast-tracked China's parallel financial architecture, advancing it by years, possibly decades. The irony is stark. Assets were seized to punish Russian aggression. The principal strategic beneficiary was China, Europe's long-term geopolitical competitor. The legal consequences are still unfolding. Russia has filed cases across multiple international bodies, including the International Court of Justice, the Permanent Court of Arbitration, and the European Court of Human Rights. These proceedings will take years, and Moscow is unlikely to recover the money. But the objective is not restitution. It is precedent. Russia is building a legal record, documenting what it argues are breaches of international norms, to establish arguments other states may one day use if they face similar treatment. This is a long-term strategy. Every adverse ruling reinforces a dangerous principle: that power, not law, governs international finance, that property rights depend on political alignment, that legal protections are subordinate to geopolitical interests. Such a system is inherently unstable, and instability favors those with less to lose, states like Russia, far more than established financial centers like Europe. Privately, European officials are beginning to acknowledge this. Off the record, policymakers concede that the seizure was rushed, legally fragile, and strategically underestimated. They admit the Russian response was more sophisticated than anticipated, and that the long-term costs may outweigh the immediate gains. Publicly, however, there is no room for retreat. To reverse course would be to concede error, a political impossibility, yet escalation carries its own risks. The result is paralysis. The damage continues to accumulate. Capital outflows persist. European assets lose appeal. The euro weakens. Borrowing costs rise. Ukraine received vital support, funds that helped meet urgent needs. But Europe has paid a far higher price in lost investment, capital flight, and diminished strategic standing. The question European leaders should have asked was straightforward. Was transferring $15 billion worth undermining Europe's financial credibility for a generation? That question was never seriously confronted. Now, the consequences are becoming clear, and they will shape the financial and political landscape well into the years ahead. European bond markets responded accordingly. Yields rose, borrowing costs increased at exactly the moment governments needed to fund Ukraine's support and energy transition programs. The European Central Bank faced a dilemma with no easy answer. intervene aggressively and risk reigniting inflation, or allow yields to climb and expose governments to mounting debt pressures. In the end, it chose a compromise, limited intervention that prevented outright crisis but failed to restore confidence. And that lack of confidence now hangs over Europe's financial future.